Market watcher Michael Block, who came decades after Eisenhower, but he's here anyway to offer his expertise. We got Fox Business's Charlie Gasparino, and Deirdre, I think I was born under the Carter administration, Bolton. All right, so good to have all of you here. Thank you very, very much. But, John, it's always about the issue now, paying for it and all that. Does Wall Street now... I'm sorry, Michael, I'm looking at John Decker here. Do you think that the dust up on this is going to go anywhere, or does the president have to concede something on a federal gas tax, as I was raising with John, or no?
It's really a tightrope here, but I don't think he has to concede anything. We're making this assumption that markets really care about these deficits. Long term, these deficits matter a lot. Short term, we keep learning over and over again we don't care. I've been hearing this for almost 10 years now.
Look at Wall Street today. You're exactly right.
And that's what's going on. First of all, the stock market loves it. The thing we have to worry about is the bond market. And I know earlier there was some talk about reaching a tipping point in the bond market. That's really the risk here. It's too much pain going to be felt and take everything down. Right now, I'm not getting that indication, last week's action notwithstanding. It seems like this is able to go through. From a political standpoint, putting on a gas tax while trying to do this is playing with fire ahead of midterm elections. And some of these GOP conservatives really need to watch that if pushing back on all this spending, it's really going to hurt them with certain voters in November, and they have to worry about that.
And I do find it a little odd, Deirdre, that a lot of Democrats are lecturing the president how you're going to pay for something. But leaving that aside, it's sort of like me offering dietary advice. I wouldn't go there.
Yeah.
But he is throwing it out there. And now if the markets are worried about yet another boondoggle or something that can't be paid for, I really kind of think that Michael hit on it. They have a funny way of showing it.
They do have a funny way of showing it, but I do think we have to remember the context, right? All last week, we were all here a gazillion hours like, oh my God, this sell-off is so widespread, and there are worries in the bond market that eventually pressured the stock market.
So this would be more stimulative and push interest rates potentially back further.
Yeah, and I also just think it's a worry that how are we going to pay for it is not really a question that I feel like we can ignore. And then when we sell debt, let's just say, to pay for it, who's going to buy? I mean, we are the #1 holder of our own debt. China also holds a lot of our debt, right? Like, what if they're a little less interested, or do we face a downgrade? I do think there's a point of reckoning where we can't just spend and spend and spend, even though from a citizen's point of view, every time I'm on a train or going through a station, I'm like, this really needs an upgrade. But the question of who pays and how, I think those are pretty big questions.
The issue, too, is the president and how much he's behind this. He is certainly in his comfort zone here, Charlie, right? He likes doing business. He's a guy who's done a lot of this infrastructure work himself. But again, it's about the money.
He likes to spend money. We should put a chart of the 10-year up. And I mean, I think that's worth looking at right now if we can get that up. 10-year has been spiking, and it's spiking again today. Look at that. That's the yield going up. That means the prices are going down. That means if this thing keeps going like this, okay, if the tax cuts don't produce the type of GDP that we need, if the budget deficit does widen out dramatically, this is really bad for the markets. And it could happen. And I think what was happening last week was, again, that debate was coming home. There are two sides to the story. Some people think it's going to be great. The stimulus is going to be great from the tax cuts and all the spending. A lot of other people say, whoa, the budget deficit is going to widen out dramatically. And he has to start showing better than 2.5% growth soon, or else that's going to be the narrative. Look at the deficits. 2016, we had a $586 billion deficit. 2017, a $666 billion deficit. A little ominous there. 2018, 873, I guess, is the projection. 2019, 984. Even in 2020, they're predicting a 987. Now,
by the way, they submitted a 10-year plan that doesn't balance itself. They've recognized that. Are you worried about it? Do you think that the fact the stock market's up, bonds aren't really budging today, given the chart notwithstanding over the last week or so, what's going on here?
Really, what's going on here is, we see these scary numbers. I see this $7 trillion handle on a deficit when we go out to 10 years, based on what we just saw today. And that is scary. But what does that mean? Does that mean I sell all my stocks, hide in the closet, and get short the bond market while I'm at it? Before I do that, I want to talk to the guys who were shorting the Japanese bond market 20 years ago. That's been a graveyard. That trade has never worked, and it's never going to work. And the point is this.
You're not worried about, let's say,
I'm not worried about
inflation, period.
I'm guarded on that.
Okay.
We see wages going higher. We saw that 2.9% year-over-year print in wages. We have some more data coming. We have Wednesday. Let's see if this is going to be the Valentine's Day massacre. The point is, what I'm seeing in the bond market now, what I'm learning today
What's Wednesday? The CPI report?
Wednesday morning is CPI.
Retail inflation.
Which, ironically, the consensus for that is a sequential downtick from last month.
But this is not going to be a debate. I don't think we're going to get these sort of existential market answers in the next 3 weeks.
So here and now,
but
let's.
Oh yeah, okay. Take a breath, a deep breath. I don't think it's Armageddon now, but I'm telling you, if we don't get. If this thing really does go to, if this gets wider than 900 billion in 2018, meaning the deficit, and you really could have, and we don't get decent growth. I'm telling you, we need.
Well, that's going to be crucial, right, Deirdre? You got to see growth.
And then also, I do think state taxes have to go higher, local taxes have to go higher. I mean, I don't know how else to finance this. So then, and when you're talking about all these breaks that corporations have given people,
that's not good.
Does it matter
if state
they
taxes
have to
go higher? It's not good.
The way I look at this for stocks right now, because I'm saying, okay, here and now, what should we do with this? What you mentioned is important, and we already had that SALT deduction go away in states like New York and New Jersey. To me, mid-year, we could see consumer discretionary health care and housing hit a wall. But right now, I'm viewing last week's sell-off as a gift. We had this big stimulus news. Industrial stocks and transport stocks, which were really over-owned and over-loved, have come in. That's a gift. Those are the ones you want to buy right now for a trade.
You think?
I think there's going to be some bumps and bruises along the way. You don't clean up a mess all at once. There's going to be a little more broken glass and little spots on the floor.
But can I just ask you, I mean, consumer, 2/3 of U.S. GDP, right? Like, we drive the economy. If you're paying more in your state taxes, more in your local taxes, and not just New York, New Jersey,
how's that good
California.
for growth?
It's not. It's a blip.
Well, then, if you're saying that's not good for growth, if you're saying the corporate tax cut doesn't really help growth, if you're saying you're not getting above 3% GDP this year, we're in trouble. I mean,
like, who wants to buy our debt is what I'm saying.
They're going to have to sell a lot more debt. Rates will have to spike. By the way, they're normalizing on top. That's what I worry about, that this corporate tax cut doesn't produce the bang for the buck. Do companies sit there and just hoard the cash? Do they?
Well, even if it does produce a bang for the buck, will it offset the higher rates that come with it? In other words, which wins out?
That's the tug of war here. I'm in a camp that says it's going to win, that the growth is going to win out. Look, I'm no Trump cheerleader here. I think y'all know that about me. But I'm looking at this and saying stimulus works.
He's such a suck up. It's like a
I
love the guy.
He's the biggest fan. He waves a pen and everything. I know. Yeah, sure.
But the hat, the whole thing.
But my point is, there's concerns about the consumer, and that is the biggest driver of GDP.
Very good point.
But is it big enough? I'm saying no here.
Well, it's 1.5 trillion on the corporate side. The individual tax cuts were pretty. I don't care what anybody. I'm going to get tons of.
But they're paying it forward. I think they are getting a little bit more from this than they envisioned.
The individual tax cuts are given to people who are on the lower end. Really, it wasn't. It isn't as stimulative theoretically as the corporate tax cuts.
I think you're underestimating how strong it could be. I too, have had my run-ins with this White House. I'm just saying though, we could be gauging just how much oomph this tax cut has.
I hope you're right.
I hope, I hope so.
That would be great.
Right.
Well, then, if that's the case, Neil, then you buy the market because GDP is going to grow to the extent that it could pay for the tax cuts. That's the plan.
We shall see.